Welcome to Wall Street Week, the show of record for long-term investing. I'm Anthony Scaramucci.
And I'm Gary Kaminsky. It has not been a summer bummer for stocks, at least not yet. Even as Janet Yellen and the Fed hinted coming interest rates, the markets continue to flirt with new highs.
Are investors ignoring a buzzsaw on the horizon? We're joined this week by J.P. Morgan Vice President and Global Market Strategist Gabriela Santos, along with Shaffer Asset Management CEO Dan Shaffer. Gabriela, let's start with you. August was historically been a so-so month for stocks, and September's by far the worst month since 1928. Should investors be a little more cautious than they're being right now?
This has been a good few months, especially for cyclical sectors within the S&P 500, and I think it is justified by better economic data and by better perspective for earnings going forward. So as we approach September, as we talk more and more about an upcoming Fed rate hike, one thing that we're really telling our clients is we don't have to be scared of a rate hike. And this is something that FOMC member Dudley mentioned last week, is a rate hike would be a good thing because it means that the economy is solid enough to justify normalizing rates.
You know, Dan mentioned, Anthony mentioned about September and August. That's historical.
Yeah.
Can we even look back at history when we have a market that is so controlled by the Fed when we think about looking back and thinking ahead?
Absolutely. I study cycles. I go back hundreds of years in markets and just put this into 1928. That's where the cycle is now. The Federal Reserve came out in 1913. They thought they had all the answers, and they manipulated the markets during the 20s, and then it just finally got out of control. In fact, in late 1928 and early 29, a lot of major players were shorting the market, where the Fed actually called them up and asked them to stop after the crash. And we're hearing today a lot of these top guys are hedging, they're covering their portfolios, or they're not fully exposed. So I think that we have a historical piece there. And also Bernanke, who was the former head of the Fed, you know, he studied this period of time. So that's one of the reasons that rates are staying so low artificially, which I think is totally a disaster. I mean, it's just, so just looking at that time period, yes, we're very similar. But the 40-year cycle continues. If we look at back in 1973 and 74, stock market dropped 50% from January to December of those 2 years. We look in the 1930s, which is 40 years earlier. 40 years earlier was 1896, similar cycle. Go back to the Civil War, 1860s, same cycle. So yes, we are right now on the cusp, in my opinion, of something major shift in this economy and in the stock market, and I think it's going to be brutal.
Let's talk about the economy for a second. So, Gabriela, how would you rate the health of the U.S. economy?
That's a tough question. I wouldn't say it's an A+. Right? We're not at that 3% pace of growth we used to have. Things are not perfect. We are seeing some weakness, especially in the investment spending side of the economy. However, there are some positives, and we would say that they're overwhelmingly positives than negatives. And that really comes from the consumer, from housing, which is having a very, very good year and continues to improve. So it's tough to put an exact grade, but not an A+, but not a C either.
Dan, let's just go back to this morning here, because you said that you think we're at the verge of a major cycle bust here. Mm-hmm. Expand on that.
Yeah, well, just actually what Gabriela just said, the housing numbers look great, but yet mortgage applications are down. Mm-hmm. Who's buying the houses? The hedge funds. The private money is buying them as speculation and renting them out. Mm-hmm. Home ownership is the lowest it's been since 1965. That's not a good sign to me. The price-to-earnings ratio on the stock market is not good. It's at a very high level historically that has signaled a problem going back 2008 and 2000. We also have the issue of debt. The world is fixed that debt fixes problems. But when debt gets to the levels that they are today, it becomes dangerous. In fact, the report I just saw this week, the 4 major oil companies, because oil prices have come down so low, are at record levels of issuing debt just to pay their dividends. That's a problem to me. So these are parts of the total. Now, put the political picture into this thing, and it even makes it worse. So I'm connecting the dots of similarity with history and the way people behave. Now, right now, everybody thinks the stock market will go up forever. You and I have been around this business over 30 years. It doesn't work like that. But when you have artificial stimulus, you have government trying to control. I mean, Japan is buying ETFs in their stock market. If I told you that 20 years ago, you would have laughed at me. If I told you interest rates were going to be 0 in 2006, you would have laughed at me. And there's another point here. Alan Greenspan, back in the early days, 2004 and 5, when the 30-year Treasury interest rate was below the 10-year, he called it a conundrum. He couldn't understand what was coming. That's what happened in 2008, 9, 10. Now we have interest rates at 0, which in my models, because I run these models with the risk rate of return, 0 interest rates is telling us that we have the potential to go into a depression. That's what it's predicting, and that's what I'm worried about.
All right, well, even in that environment, we have to give investors and viewers an idea how to make money, so we'll do that right after the break. Gabriela, Dan, stay with us. We'll be right back.